So, good morning, friends. Today we will continue with our discussion. Yesterday's lecture we started discussing the new chapter, that is portfolio management. What this chapter is all about? Okay, this chapter is all about discount rate discovery. I told you value of the asset as per discounted cash flow method is nothing but present value of the future cash flows discounted at required rate of return of investors. When we valued bond, okay, present value of the future bond cash flows discounted at YTM, we studied there. Then when we studied equity, okay, there also using discounted cash flow method, what was the definition? Okay, present value of the future cash flows, it might be dividend or free cash flows, okay, discounted at required rate of return of equity holders, KE. Yes, we discounted the cash flows using KE. There we told how to find KE, CAPM, all these things we were telling. All these discussions are reserved for the portfolio management chapter. Okay, here what we discussed predominantly how to find the KE is what will be your discussion. And why you need to find KE, you need to understand. Okay, every security will not have same risk. I told you, Government of India bond will never have any risk involved, right? So you need to quantify the risk. So what we will do in this chapter, first we will need to find we need to quantify the risk, okay, for the comparability. You need to quantify risk of individual securities to compare across the market for all the securities available and to see how risky are these securities, individual securities. Sometimes, you know, market risk of the market it also we find out, correct? Entire markets risk also we will find out later. Sharpe single index model and all, we will find out those things also. So predominantly what is happening, we need to measure risk. First we need to measure risk of the security or portfolio. Are you understanding? Then for a given level of risk, how much we should ask, how much return we should ask. These are the two things which we are going to learn this in this chapter, correct? For a given level of risk, how much return we should ask means, okay, that will become our required rate of return, that is what is KE. Okay, how much you should ask for a given level of risk, and it might be different from person to person. Okay, a person, for example, it is going to come anyway in Markowitz portfolio theory. We are going to learn how risk averseness of the person will determine the required rate of return of those investors. Are you understanding? So these two things we will need to learn here. Then we divide the entire chapter into 5 segments predominantly. I am not telling these are all the only discussions. Okay, incidentally there will be many discussion. Okay, what are the 5 different segments we are distributed now? First segment we will discuss risk return profile. I am briefly explaining what happened yesterday. Just a quick recap of yesterday's lecture so that you can pick it from there. Otherwise it will be difficult for you to straight away jump into the upcoming topics, right? See, first segment what we are planning to discuss risk return profile. We will find how to we will see how to find risk return of the individual securities as well as, you know, portfolio of securities. Portfolio is nothing but a group of assets. So portfolio return and risk, how to find this we will see. All this we will see under risk return segment and few other discussions. Okay, correlation, covariance, all these things we will discuss under risk return profile. Then we will move to Markowitz portfolio theory, a landmark theory which came in late 1950s. Harry Markowitz, he won Nobel Prize for this theory, Markowitz portfolio theory. Then there is CAPM, capital asset pricing model, okay, which was also found by Sharpe. Okay, William Sharpe. Sharpe was also awarded a Nobel Prize for CAPM, capital asset pricing model. Then Sharpe single index model, that model also was developed by him only. Okay, the Sharpe was student of the Markowitz, right? Then arbitrage pricing theory, there is a theory called as arbitrage pricing theory. Ross, he found out the arbitrage pricing theory, and after that there is a separate topic which is what is efficient market hypothesis. Recently in 2013 or something, efficient market hypothesis got Nobel Prize. Okay, market efficiency theory that got Nobel Prize. Right. So, but we are not discussing efficient market. That is also a part of portfolio management, but we are not discussing under portfolio management as such, because we will separately discuss under security analysis. There is a chapter called as security analysis, because it comes under technical analysis of the security analysis part, which we will discuss later. So these are all the agenda for this chapter, right? Then we started how to find okay, then we started with risk return profile. There we started with how to find return. Okay, returns can be classified into two types of return can be computed on a given date. For example, you can analyze the past data and find out the average return, and you can use the probability scenario based analysis for predicting future prices and future return, because if share price you can predict by future, now using that share price we can compute the expected return for the future, right? So it is possible that we use ex post data and find out average return, as well as ex ante data with probabilities or scenario based analysis also we can do and find return of these securities. Then comes to risk also can be done using ex post data and using ex ante data, right? When we compute return using ex post data, which means past 3 years or 5 years, when you analyze what is the return of the security, okay, share price at the end of year 1 minus share price at the beginning, okay, plus dividend, okay, the whole divided by share price at the beginning. This will give you, okay, how much return, annual return in percentage terms we will earn every year, right? This we learn. Then ex ante return, how to compute ex ante return? It is nothing but weighted average return. Here, while computing ex post return, okay, how to compute average return? First we compute individual, every year, each year what is the return we will compute, correct? But whether we can assume extremes, we can expect extremes, no, we can only expect average and not extreme. So that's why when we see expected return, what we should do, we should take mean return or average return. How to compute mean in case of ex post data? Simple mean return is nothing but total number of observation, the total returns from each of the year, okay, divide the whole divided by n. Simple terms, you can find out simple average and find out the mean return, correct? Then come to ex ante return. How you found out ex ante? Okay, using probabilities. How will you compute? Okay, for each year you will see the probability and multiply the number, okay, then you will get total summation of it, you will get mean return x bar, okay, you will get x bar by these things. Then after computing return, we will come to risk. Okay, computation of return on all is not sufficient, we need to see risk, how much the risk of the security is, okay. So while computing individual securities risk, what we will do? Okay, we will see the variation from the mean. The return every year is same or different, it might be different, correct? When it comes to ex post, right, the return might have been varied in the past 5 years or 3 years, correct? So in that case, we will find out what is the variation from the mean. This is called as standard deviation, statistical measure to measure to find out the risk. Okay, it is denoted by standard deviation, sigma x, or any security you are taking, sigma x or sigma y. How to compute it? What is the formula for finding standard deviation in case of ex post data? If you analyze ex post data, now what will be the standard deviation of individual security? Standard deviation is equal to square root of, okay, summation of, what is that, x minus x bar the whole square divided by n. This is how we found out standard deviation of individual security using ex post data, correct? When it comes to probability, when there is probability, what you will do? How to find standard deviation? Okay, square root of summation of probability into p into x minus x bar the whole square, that's it. Okay, there will be no n here. Understood? Why? Because there is simple average. We have already taken p, probability based weightage we have to taken. So weighted average risk formula we found out using this, correct? Next we started discussing, we solved question number 1 and 2, which was predominantly based on these theories, correct? See here, return we found out, then we used probability based theory, right? Then portfolio risk, we started with portfolio return and risk. Question number 3, we started discussing the portfolio risk, portfolio return and risk. What is the portfolio return? Portfolio return is nothing but weighted average return of the individual securities inside the portfolio, correct? But risk will not be computed like that. I told you, portfolio risk is not weighted average risk of the individual securities inside the portfolio, but what it is, what is the formula for portfolio risk? Okay, square root of, okay, w1 square sigma x square plus w2 square sigma y square plus 2 into w1 w2 sigma x sigma y into r into xy, which means r xy correlation of x and y. This whole if you square root it, you will get sigma portfolio sigma, which means risk of the portfolio, correct? Then we started discussing portfolio risk is not risk of individual securities. Why? Because portfolio risk is affected by 3 factors. Okay, return of the portfolio was affected by 2 factors only, but risk of the portfolio is affected by 3 factors. Namely, what are the 3 factors? Risk of the individual security, proportion of the securities inside the portfolio, and co-movement of the security. Okay, risk of the individual security will also affect the portfolio risk. I am not denying that, but not only that, proportion, in what proportion you are investing in these securities, okay, it will also have some impact on the risk of the portfolio. Then there is an important factor called as co-movement of the individual 2 securities. Okay, how correlated they are and what is the strength of their correlation will be measured by the correlation factor, correct? Then we started discussing that correlation, it happens, we divided correlation into 5 parts. Okay, it is not that only 5 correlation are there, but majorly 5 different correlations possible, like -1 to +1 will be the correlation, and -1 is perfectly negative, -1 to 0 is negative but not perfectly negative, 0 there is no correlation, 0 to 1 means positive correlation but not perfectly correlation, and +1 na perfectly correlation. And we saw how the points are plotted in the graph to find out the strength of the correlation, or are you understanding co-movement, right? Then I told you one example. See, diversification reduces risk, and that risk can be reduced through diversification till you reach 1. அதாவது positive 1 correlation வரைக்கும் you can definitely reduce the risk, portfolio risk, by diversification. Don't think positive correlation means you cannot reduce the portfolio risk by diversification. It is not so. Okay, diversification still reduces risk. Okay, till 0.999 the diversification will have positive impact. Only when the correlation is +1, diversification will never help to reduce the risk. This is the entire discussion, summary of the entire discussion of the previous class, right? Shall we proceed? 2 more points I wanted to add in this segment, then we will quickly start solving questions in this regard. Okay, 2 more points I wanted to add. When the correlation is perfectly positive or negative, see here, when the correlation is when correlation is perfectly positive or perfectly negative. Perfectly negative na -1, perfectly positive means +1. In both these scenarios, what will happen na? Okay, because you are removing the correlation effect. See, very simple. In these cases, what is our formula? Portfolio risk is equal to, what will be the formula? Okay, weight 1 sigma weight 1 square w1 square sigma x square, okay, plus w2 square sigma y square, plus you have 2 into w1 sigma x w2 sigma y, correct? Or you can write 2 into w1 w2 sigma x sigma y, all these things, into correlation of x and y, correct? If this number becomes +1 na, there is no need to put this number, correct? This entire number will vanish. In that case, what will happen? You see, what will be the remaining formula? W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y. This is nothing but, okay, you can write it like a plus b the whole square na. So what do you do? Something similar to a plus b the whole square. How will you write? See here, W1 sigma x plus W2 sigma y the whole square. Correct? Are you all understanding? Is equal to square root also you remove, this also you remove, weight 1 sigma x plus weight 2 sigma y. Are you all getting this? Understood what I am trying to say? Which means ultimately this is nothing but weighted average risk of the individual securities. Are you understanding? When correlation is exactly plus 1, okay, what is the risk of the portfolio? Is nothing but weighted average risk of the individual securities inside the portfolio. Are you understanding? Observing? This is clear?
Yes, sir.
Okay, very simple. So what will do when the correlation is minus 1, what do you do? Okay, instead of plus 1, here it is plus, this sign will change to minus, correct? Upper what will happen? It is nothing but similar to a plus a minus b the whole square na. Upper square root of W1 sigma x minus W2 sigma y the whole square. It will be something similar to like this, correct? Are you all understanding? Okay, when these two if you remove, it is nothing but weight 1 sigma x minus weight 2 sigma y. This is the formula for portfolio risk when correlation is minus 1. Are you understanding? This is plus 1 correlation, this is minus 1 correlation. Is this clear? Both of these things? Okay, very basic thing. There is no formula, separate derivation and all. This is simple basic mathematics. We just applied, okay, plus 1 and minus 1 to that and arrived at this formula. Is this clear? Next, see, one more thing I wanted to tell. When correlation is minus 1, when correlation is point number 2, okay, when correlation, I am denoting correlation as R, don't get confused. R na correlation. When correlation is perfectly negative, which means maximum diversification, maximum risk reduction happens at what stage? Minus 1. Understanding? Plus 1 was a positive extreme correlation. At that juncture, there will be no risk reduction possibility, correct? Now at minus 1, it is the peak of the risk reduction. That maximum risk you can reduce at minus 1. This you are understanding? We already discussed even it can be reduced to 0 if you invest in some proportion. This is the point. Next point, we told that maximum we can reduce the risk when the correlation is minus 1, exactly perfectly negative between these two securities. Correlation between these two securities is perfectly negative. I told you we can reduce even the risk of the portfolio to 0. Completely we can reduce the risk. We told how is it possible? I'll tell you. Okay, in that case, if you are reducing the risk of the portfolio completely, what will happen? Okay, at some proportion if you invest, you can reduce it completely, correct? If I put some 40% of x and 60% of y, what percent of x and y I don't know. I am trying to find now. Are you understanding? But I know that at some proportion I will bring the risk to portfolio risk to 0. Okay, this will become risk free portfolio. Are you understanding? So that proportion, at what proportion you will invest x and y, that proportion is called as minimum variance portfolio. Minimum variance portfolio. Okay, at what proportion? I will tell you. There is a formula for it. I will derive the formula and show you. No big deal. Proportion of x. X is a security, how much percentage of x should be there in the portfolio and how much percentage of y should be there in the portfolio, so that the constructed portfolio's overall risk becomes 0. That is what we are discussing, correct? If correlation is minus 1, perfectly negative, there is a possibility. How to find the proportion? We are giving a formula and I will derive the formula. So P of x is equal to P of x na proportion of x. Proportion na weight of the x, correct? We will get some percentage, 35%, 25%, like that. If 25% is x proportion, y's proportion will be 75%. Are you understanding? Total will be 1, right? Proportion of x is nothing but sigma y divided by, okay, sigma x plus sigma y. Same way, proportion of y is equal to sigma x divided by sigma x plus sigma y. See here, very simple, easy to remember, I will tell you. Sigma x and y are common in this both. Are you all observing? Denominator same both. Okay. Proportion of x you take sigma opposite x y, sigma y you take it as numerator. Are you understanding? Proportion of y when you are finding, okay, numerator is sigma x. That's the difference. Denominator will be same. Correct? This will be, how this will be derived, very simple. You don't need to by heart also. I will show you how this is derived. Very simple. You already know that, okay, proportion of y. Let us take proportion of y, okay. Proportion of y is nothing but only two security portfolio we are discussing, correct? Upper proportion of y is nothing but 1 minus proportion of x. This you are agreeing, 1 minus proportion of x, correct? Are you all able to follow?
Yes, sir.
Shall I continue? See here. The total will be 100%. I told you 100% and 1. Just like probability we found out, the total will be 1. Same way, here total proportion of x and y will be 1. 1 means 100%. Correct? Appo proportion of x will be 1 minus proportion of y. Correct? This you are agreeing. Now, sigma p is equal to, okay, proportion of, what is the sigma of the P, you see portfolio, proportion of x into risk of x minus proportion of y into risk of y. How we got this? Very simple, when correlation was negative, this is the weighted average risk of the individual security, when correlation is perfectly negative, when correlation is -1, exactly -1, then your risk of the portfolio will be nothing but weighted average risk of the individual security. I told you this will be your portfolio risk, correct? Are you understanding? I am just taking this and substituting. Are you observing? See here.
Yes, sir.
I am just substituting that number here, sigma of the portfolio, when correlation is exactly -1 or perfectly negative. Correct? Upper sigma of that portfolio at that point will be what? This is the sigma. Portfolio sigma, sorry. Are you understanding? Now, what we will do, okay, we will simply, we got portfolio y in proportion of y as 1 minus proportion of x, correct? We will substitute here proportion of y with same 1 minus x, correct? Upper portfolio risk is nothing but proportion of x into sigma x minus, okay, 1 minus proportion of x, that is what your proportion of y is, correct? Into sigma y. Now you can remove the either. What we will get? Okay, proportion of x sigma x, right? Minus 1 into sigma y, minus sigma y, minus plus plus proportion of x into sigma y. Are you all getting? Right? Now I told you at some proportion the portfolio risk will become 0, correct? This is the portfolio risk, okay, you need to equate it with 0. Are you understanding? Left hand side will become 0, How? Because at some point the risk reduction will happen and that reduction will be exactly 0, So that is what we are finding. Upper 0 is equal to, tell me what will happen. Okay, you will, what do? You will take proportion of x as common. Proportion of x as common. What you will get? Sigma x, correct? Sigma x plus proportion of x na inga sigma y irukku illaya, that sigma y we will take, then we will close it, inga minus sigma y will be there. Are you understanding? This sigma y will be separately put here. Okay, 0 is equal to proportion of x sigma x plus sigma y minus sigma x. This sigma y we can bring it there. Sigma y is equal to, okay, px proportion of x sigma x plus sigma y. Understanding? Appo proportion of x is equal to sigma y divided by sigma x plus sigma y. This is how you get, okay, minimum variance portfolio. Is this clear? This is what we called as minimum variance portfolio, which means the proportion of x which we should put okay, so that our portfolio risk has become 0. Understanding? Listen here. Good morning, friends. Important discussion. Are you all alive? See,
Yes, sir.
I can reduce risk till my correlation of the security is positive 1. I told you, correct? And from positive 1 I can keep on reducing by diversification till I reach minus 1. At point minus 1 maximum, I mean till I reach minus 1, inversely, okay, maximum you can reduce till you reach minus 1. Maximum risk reduction happens at what stage? Minus 1 correlation, when the correlation is minus 1. Appo assume there are two securities x and y. If the correlation is different, never forget about it. If the correlation of those two securities are different, you can never bring the portfolio risk to 0. Forget about it. But what I am telling is, okay, if the correlation is perfectly negative between two securities, we can construct a portfolio, okay, by investing x and y in such a proportion that the portfolio becomes risk free. We can bring the risk to 0. Later it will be questioned under CAPM and other theories. Okay, don't worry, sharp single index model and all, it will be questioned. But for now you understand that it can reduce the risk to 0. This is called as minimum variance portfolio as per Markowitz theory. Are you all understanding? Same way, this is same way. I don't need to show derivation for proportion of y also. Proportion of y also is nothing but you will get sigma x by sigma x plus sigma y. This is what you get when you equate it. Okay, are you all understanding this discussion? Is it clear?
Yes, sir.
Only when, should see, always you should remember, only when the correlation is perfectly negative this is possible. Otherwise my portfolio risk can never reduce to 0. Yeah, in any proportion you invest, it will never bring the portfolio to 0, which I will, of course, we learn under Markowitz portfolio theory. Okay, are you understanding this basic minimum variance portfolio? Right? See, now I have given, see, I have given notes also. You can go through here in the notes. Where it is, I will tell you. Okay, you can go through from notes, revise from notes later. That is what I wanted to tell. See here. See, can you see this? See here, when correlation is perfectly positive, no risk reduction happens. When correlation is perfectly positive, this is the portfolio formula. It is nothing but weighted average risk of the individual securities. Are you all seeing? When correlation is minus 1, this is the portfolio risk. But one more thing is, when correlation is minus 1, the standard deviation of portfolio can even be reduced to 0. Okay, through investment in proper proportion, in some proportion. Such a portfolio is called as minimum variance portfolio. It is calculated as follows. I also showed you derivation of this formula. Understood? Now we will continue solving question. See here, take question number 3 for discussion. Yesterday we started question number 3. I think risk we have finished completely, or is there anything pending there? See, question number 3. Have you all noted all the solution? See, check your notebook. Portfolio return we computed, I know that for sure, correct?
Yes, sir.
Have you all copied the portfolio risk segment? See, this you copied. 10.74, this also you copied, na?
Yes, sir.
Right. So next question we shall ಓ ಇದು ಬೇರೆ ಏದೋ ಚಾಪ್ಟರ್ இருக்கா ಓಕೆ ಓಕೆ ನೌ ಕ್ಯಾನ್ ಯು ಸಿ ದ ನೋಟ್ಸಾ
Yes, sir.
ಸಿ take question number 4 for discussion. Optimum portfolio proportion. Novex owns a portfolio of two securities with the following expected return, standard deviation and weights. Securities X and Y. Expected return is 12%, 15%. Standard deviation for X and Y is 15 and 20%. Weight given for these individual securities inside the portfolio is 40% and 60%. What are the maximum and minimum portfolio standard deviations for varying level of correlation between two securities? Are you understanding? Okay, varying level of correlation, maximum and minimum portfolio standard deviations they asked us to find. Then next part, if correlation is -1, calculate the proportion, okay, proportion of the individual securities in the portfolio to reduce the risk to 0. Take a minute time to read the question, then we will start with our discussion. See, very simple and straightforward. Only one question I will ask you. Okay, they have given the risk and standard deviation of individual securities, return of individual securities and weight of the security, proportion of the security. What is the last column? Weight and irregular. What is that? Proportion. Which means my portfolio consists of only security X, security X and Y, security X and Y. And in what proportion it contains security X and Y? 40% of security X, 60% of security Y. Very simple pa. If X and Y is Reliance Limited and Infosys Limited, I have a portfolio value of 5 lakh rupees. I have invested 5 lakh rupees na. 40% of my 5 lakh rupees, which is 2 lakh rupees, I invested in Reliance Limited, and 60% of my wealth, அதாவது 5 lakh rupees is 3 lakh rupees I invested in Infosys Limited. This way I construct a portfolio consisting of 2 shares. Are you understanding? Okay, proportion you are comfortable with? Right. Now only one question I will ask here. Is there any correlation given between these two securities?
No, sir.
No. Which means, see, without getting correlation data, we cannot find portfolio risk. Correct? But they have given, asked something. What they have asked? What are the maximum and minimum portfolio standard deviation for varying levels of correlation between two securities? See, you take correlation as any number. When will maximum portfolio standard deviation will happen? Risk.
-1.
No, maximum portfolio deviation, risk. Higher the risk,
Okay.
higher the portfolio deviation. Are you understanding? Which means deviation na risk na, standard deviation means risk. So a point when maximum risk happens, when is that? +1. When correlation is +1, then only maximum risk happen na. Are you understanding? The portfolio risk will be too high, maximum. So that is why they have not given. Adanalada they have given that what is the maximum and minimum portfolio standard deviations for varying levels of correlation, which means when the correlation of these two securities is perfectly positive, then only maximum risk will happen. Correct? Because they have not given correlation, we need to assume that. Question is self asked, when there will be minimum standard deviation of the portfolio, okay, maximum reduction in the risk of the portfolio when the correlation is -1. Correct? That is what they have asked. Are you understanding? Comfortable? Okay.
Yes, sir.
See,
Yes, sir.
see what are the maximum and minimum portfolio standard deviations for varying level of correlation between those two securities? Now, nothing but we need to find the correlation positive. Now, what is the portfolio risk when the correlation is assuming correlation as +1 and portfolio risk assuming correlation as -1? Shall we see here? First, what we will do? We will compute return. Okay, portfolio return. They have not asked us to compute portfolio return. Still, we will compute. In a practice purpose, we will compute that also. Okay, how to compute portfolio return? First, see here, security, proportion, return and weighted return. What are the securities involved? X and Y. What is the proportion given? 40% and 60%. You can write it in decimal, 0.4 and 0.6. Correct? What is the return for individual security? Is 12% for X, 15% for Y. Okay, what is the weighted return? 12 into 0.4, what is the return? 4.8. 15 into 0.6, you will get it as 9. What is the expected return or average return of the portfolio? is nothing but 13.8%. Okay, next, portfolio risk. See here. Maximum portfolio risk. When will maximum portfolio risk occur? When will maximum, the risk will be, portfolio risk will be maximum when the correlation between these two securities is positive 1. Okay, see here. Portfolio risk is equal to, when positive 1, correlation is the positive 1 between these two securities, what will be the portfolio formula? You should tell me. The 2 into the correlation will become positive 1 na? Then it is something similar to a plus b the whole square na? Correct? Then it is nothing but portfolio risk will be nothing but, okay, individual weight of the individual securities, weighted risk of the individual securities inside the portfolio. W1 sigma x and plus W2 sigma y. What is that? 0.4 into 15 plus 0.6 into 20. How much is that? 18%. Minimum portfolio risk. When will the portfolio risk be very minimum? Okay, 0. We can bring it to 0 na? Correct? At what correlation level we can bring the portfolio risk to 0? -1. Upon correlation when is -1 between these two securities, our portfolio should be minimum. Our portfolio risk should be minimum. Okay, even we can bring it to 0, right? The portfolio risk is equal to, what is the formula for that? Minimum variance portfolio. Now how you should do? W1 sigma x minus W2 sigma y. If you are alert, tell me why there is minus. Because -1 correlation na, the net effect will be minus na. Are you understanding? Appo a square plus b square minus 2ab nu varum. What is the formula for a minus b the whole square? A square plus b square minus 2ab. Are you understanding? So it will become a minus b the whole square na. Like that you should think. Okay, W1 sigma x minus W2 sigma y. Okay, 0.4 into 15 minus 0.6 into 20 is equal to 6%. Inge ஒரே ஒரு doubt வரும். Are you all observing? 0.4 into 15 minus 0.6 into 20 is minus 6, not 6. Correct? You are all having calculators, sir. See here, try that. 0.4 into 15 minus 0.6 into 20. Now right hand side it is the number is more than the left hand side number na. So ideally I should have put minus 6%. Correct? But I only put 6%. We don't need to put minus and all. Minus is irrelevant. Sign is irrelevant. Why? Because see, risk itself denotes the variation. Variation from what? Variation from the mean return. This 6% is what? Risk na? Risk, how you are computing? Variation from the mean return. Appa minus 6 na, see, if it is reducing 6% from the mean, increasing 6% from the mean, it doesn't matter. It is varying from the mean. Mean madhyathla nadula irukilla. Okay, in the middle of the thing you have mean. Correct? It can vary this side, that side, it doesn't matter. Sign is just okay, here it doesn't matter. 6% na, variation is 6%. I don't care whether it varies on the downward side or upward side. Are you understanding? That is why 6%. Doubt varlanalo naaliki varum. Sometimes when you revise this, doubt may arise. Are you understanding? Okay, so we should we simply put it as 6%. Correct? Next, first part is answered. Second part, what they have asked, please tell me. If correlation is -1, calculate the proportion of the individual securities in the portfolio to reduce the risk to 0. Very simple. Optimum portfolio proportion. Just now we computed not. What proportion we should bring it to 0. Inge pare, one thing you should very clearly understand. In this first part of the question, they have clearly given the proportion already in the question. Adavadhu 0.4, 40% of your value, portfolio value should be invested in, amount should be invested in X. 60% of the amount should be invested in Y. This they have clearly given. Correct? If this is the proportion, the minimum risk for this proportion is 6%. You should not ask, sir, you told that at correlation -1, the risk is 0. We found out the risk is 6%. 6% is equal to 0. You told that at -1 correlation, you can bring the portfolio risk to 0. Na? Are you all understanding the doubt first?
Sir.
Yes, sir.
Friends, carefully listen. Question la, what is the proportion given in the question? 0.4 and 0.6 for x and y.
0.6.
Is this clear? First,
Yes, sir. Yes, sir.
with that data, they have given correlation is -1. அதாவது maximum risk reduction happens at -1 correlation. Correcta? You should not think at -1 correlation na any proportionally if I invest my risk will be 0. Are you understanding? See,
Yes, sir.
very simple. If my correlation is -1, what I am trying to say is, carefully observe, if my correlation between the two securities is exactly -1, I can even bring the risk to 0, but only by investing in some proportion as per the formula which I computed na. Proportion of x is equal to, I derived na, sigma x, proportion of x is equal to sigma y by sigma x plus sigma y. Likewise, proportion of y is equal to sigma x by sigma x by sigma y. This, by this formula you can reduce it to 0 portfolio risk, but only when you find out the proportion using that formula, you invest in that proportion, you will bring the portfolio risk to 0. This is clear first. In this question, -1 correlation is there, but the question given proportion is what? 40%, 60%, na? That is not the proportion as per the formula, na? So it is not the ideal proportion wherein you can bring risk to 0. Which means if you invest, even if the correlation is -1, carefully observe, even if the correlation is -1, okay, the proportion, since they are investing, is not as per the optimum proportion formula. For at 40% and 60%, you can reduce the risk to only 6% and not to 0%. Why? Proportion ideally should be different. That is what we have asked to find out. In the second part, enna theriyuma, is all about finding the proportion. Here in the question they have put 40%, 60%, na? Correct? But in the second part of the question, they have asked to construct a proportion, find a proportion at which the risk will be, instead of 6%, bring it to 0%. Are you understanding the difference? Now, is this clear? See, you will understand. Once I solve the question, you will understand it better. See, optimum portfolio proportion. Now, which means, see, the previous slide, the risk was 6%, na? Portfolio risk. Correct? At -1, you told that risk can be brought to 0, na? Correct? Now 6% is equal to 0, no, na? So you have not brought the risk to 0. Now they are asking, use a good mixture of these securities so that the risk becomes 0. In what mix you will use this security? Now they have used 40-60%. Now we see that using by 40-60%, we are not getting the portfolio risk as 0. Now they are asking, construct a portfolio proportion. Okay, construct a proportion of the portfolio by which the risk will become 0. This is what they are asking. See here, next segment la par. Optimum portfolio proportion. What is that formula? I discussed na, proportion of x is equal to, you should tell me, proportion of x is equal to sigma, numerator la sigma y divided by okay, sigma x plus sigma y, okay, is equal to sigma y. How much? In this question they have given 20. Correct? What is the sigma y? See here, pa? Standard deviation is sigma 20. Risk of the security y is 20. 20 by sigma x plus y is how much? 15 plus 20. How much is the 20 by 35? How much percentage? 57%. Are you all getting? 20 by 35. 57 varda? Is it correct? Use your calculator. Okay. Whenever I am discussing question answer, why I am discussing first and letting you copy in a later? Because I want you to participate, but calculator you should use and ready-made calculation you should do whenever there is requirement of calculations. That is why you are participating. When you observe and participate, thereafter entire discussion will become easy. Next, proportion of y. Okay, it is nothing but 1 minus x, 1 minus 0.7. It should be 43%, but we will still apply the formula and check it. Okay, sigma x by sigma x and sigma x plus sigma y. How much is that? Okay, 15 by 15 plus 20. How much is that? 43%. Okay, now copy this down. Later we will check If we use this proportion, are we getting risk as 0? Okay. See here, 57-43 percentage is the risk, na? The proportion, na? We will see at this proportion what happens. Can you help me out? Question number 3, yeah? Question number 3. Correct? Here.
4, sir.
4. Okay, 4. Question 4. Here, see here, what is the portfolio risk? Correct? Portfolio risk formula, you should tell me weight 1 square, weight 1 is 57. What is the weightage of X? 57%, na?
57.
0.57 square into, okay, what is the risk of the X? What is the risk of X? Sigma X, how much? 20, yeah? No, 15. Sigma X into 15 square plus weight 2 na 43.43 square into sigma 20 square plus, okay, 2 into what is that? 2 into weight into 1.57 into 0.43 into sigma X sigma Y into 15%. 15% is 0.15 into 0.20. Okay. Into correlation, na? Correlation is -1. Correct? Upper -1, na? This will become, instead of plus, this will become minus. That's it. Correct? We can also summarize, I told you, na, at correlation -1 is nothing but weight of 1 sigma X minus weight of 2 sigma Y. Correct? We don't need to solve all these things.
Yes,
here.
sir.
It's just a plus b the whole square mardana. Okay, we told na is equal to, just tell me, 0.57 into 15%, we can write it 0.5, yeah? Correct? Minus or 15% itself you can also denote. Minus weight 2 is 43, we can write it 0.53 into Y percentage. What is the Y? 20, na? 20. Please check it and tell me, is it coming to 0? See here, use the calculator. 15% into 0.57. What is that?
0.086.
0.086 na 8.6 percentage. Correct? 15% into 0.57, 8.6 minus 20 into 4.3, that is also 8.6. Is it equal to 0?
8.6.
Are you all understanding? My portfolio risk is becoming 0. Now proved? Now clear?
Yes, sir.
If your weight of the individual security in the portfolio is 57% of X and 43% is the weight for Y, if you give this weight, what will happen? My portfolio risk will become 0. This is called as minimum variance portfolio. Are you understanding? This is also possible to construct, but in the question, when they give 40% and 60%, you compute as per the weight taken in the question. Only when they ask us to find the proportion at which we can construct a minimum variance portfolio, now you find the weight of X and weight of Y. Are you all clear with this? Shall we proceed? Next, take question number.
Yes, sir.
Now risk-free return we need to find. Na? See here. Now, return of the same continuity, you can write simultaneously return of portfolio, same question. If the proportion is, if proportion of X is 57%, proportion of Y is 43%. Correct? Now what we are computing? Return of portfolio. What is the portfolio return? Weighted average return of the individual securities. Correct? Now X and Y securities, X and Y return, weighted return. Okay. See here, return. What is the security return of X and Y? What is given in the question? 12 and 15%, na? Expected return, average return 12 and 15. What is the weight for X? 57%, 43%, 0.57, 0.53 also you can write. Okay, what you will get? Tell me friends. 12 into 57%, 6.84. Then 43 into 15%, how much is that?
6.45.
Total, what is the total of these two?
12.9.
portfolio return is equal to 12.9. Are you understanding? Okay, this is the portfolio return, risk-free return, which means even if you take zero risk, if the risk is zero, even at the level of zero risk, you will get 12.9% as return. If you see in the question, very interesting fact.
It's 13.29, sir. Okay.
13.29, huh? Okay. 13.29. Okay. If you carefully observe in the question, okay, even more higher, la? Very good. If you carefully observe in the question, the beauty is the security X is there, na? Okay. Which is having, how much is risk of the security X? 10%, 15%. Are you all observing? See, pa.
Yes, sir.
Security
15
X or the risk is 15%. What is the standard deviation of security X? 15%. The beauty of this question is, the beauty of diversification is, okay, the security X's standard deviation is 15%. Understood? And the return is only 12%. Yeah. Understood? Okay. And here the portfolio risk is only 0%, which means we have no risk at all. If we construct a portfolio, okay, of this proportion, we have zero risk, but return to our surprise is even more than individual security of X. Puriyada what I am trying to say? Are you understanding?
Yes, sir.
13.29 is risk-free return, is having any risk?
Risk-free.
Risk-free. Why risk-free? This is the return at portfolio zero risk, na? Zero risk portfolio, na? So this is risk-free return ideally. The beauty is the risky asset, so-called risky asset in the name of X, na? X irukilla. Okay, the X limited share is risky to the extent of 15%. That X is giving only 12% return, yeah. But this portfolio return, which we constructed, risky asset, 13.29% is giving return. This is the beauty of diversification. And one more thing, if you notice, Y is having 20% risk. Are you understanding? Okay, X is having 15% risk, but if you combine both these, the risk becomes zero. But the correlation is to be negative, perfectly negative. Are you understanding? Right.
Sir, but earlier also it is 13.8, right? Portfolio return.
Yes. See, portfolio return, but that portfolio return has risk, na?
Yes.
This is risk-free reset, na? Risk-free return. See, if you go to bank and invest in FD, you will get 6 or 7% return maximum, risk-free return, guaranteed return, correct? Anywhere in the equity share, these two are X limited and Y limited and equity shares, na? Anywhere in the equity shares, if someone is offering 13.3% risk-free rate, na, I will invest my money for 30-40 years, yeah. Are you understanding? You know what will happen. I told you in equity itself, if you invest for 30-40 years and compound it for 14%, you will be billionaire. Are you understanding? Even if you start with small amount. That is the wonder of compounding. So, you know, risk-free, who will offer you risk-free rate of 13.3%? That is the entire logic of this chapter. Because individually, these two securities are risky securities. Security X is 15% risky, security Y is 20% risky. Still, I can construct a portfolio in such a manner using such a security which correlation of -1 so that my risk becomes zero and my return will be so higher than the risk-free return ordinarily. Ordinarily, what you get from risk-free return, Government of India bond, how much is higher? Are you understanding? Okay, Government of India bonds is offering 6 to 7%, na? 13.29 is so high from that, na? Nearly double the return without, okay, even taking 1% of risk. Are you understanding? This is the question. Take question number. Okay, have you understood this fully? Shall I proceed?
Yes, sir.
Okay, take question number 5. Yeah, yes, take question number 5 for discussion. L limited and M limited, okay, have the following risk and return estimates. RL, what is RL? Okay, return of L. RL, na, you should understand, return of M. M is return of M. Okay, sigma L na, risk of L is 18%. Sigma M na, risk of M, individual security. So L and M are individual securities which is having individual return and risk, correct? Correlation they have given perfectly negative, -1 na, correct? Perfectly negative correlation they have given. Calculate the proportion of investment in N limited and M limited to minimize the risk of portfolio. See, they have calculated proportion. Why? Minimize na, if correlation is -1, can you bring the portfolio risk to 0? Yes. In such a proportion, okay, we can bring the portfolio to even 0. How to calculate that proportion? Proportion of x is equal to, okay, risk of y, sigma y divided by sigma x plus sigma y. Proportion of y is equal to sigma x by sigma x plus sigma y. Correct? Okay. This is simple straightforward question. Now already you have solved this type of question. See here. Optimum portfolio proportion. PL, proportion of L. What is PL? Proportion of L. Px x and y in, we have replaced it using L and M. Okay, PL na L. Okay, proportion of the L. What is the weight of L? Sigma M by sigma L plus sigma M. How much is that? What is sigma M? 15 divided by 18 plus 15 percentage. Okay. See here, I have directly taken as 15 and wrote like this. Okay, what you should do ideally in examination and all, you can take 0.15 divided by 0.18 plus 0.15, like that you can take. Answer you will get same. Okay, you can also write it percentage to anything you can do. Are you understanding? See here, how much you will get? 45.45 percentage. Okay, next proportion of M. What is the formula? You should tell me. Proportion of L is how much? Sigma L divided by sigma L plus sigma M. How much is that? Okay, 18 divided by 18 plus 15 is equal to 54.55. Next, what we need to compute? Risk-free return. They have asked, not asked, they have not asked, but still we are finding. Okay, we have minimized the portfolio risk to 0, which means at 45.45% of L if we invest our money in L, and 54.55% if we invest our money in M and construct the portfolio, the risk will be 0%. Just now we computed, computed in the sense what? This proportion is for risk free, -1 is the correlation, so risk will be 0%. At this risk percentage, what is the return? Risk free return, we will compute that also. They have not asked in question finishes here itself, but for computation, for getting used to the concepts we are discussing. Risk free return is what? Security proportion return and weighted proportion LN. What is the proportion? Now we found out 45.45, அதாவது 0.4545 and 0.5455. Return is 20% for L and 22% of M. So weighted return is, okay, risk-free return is 21.09%. Are you all observing? See, in a classic thing is happening. Individually, okay, return of the L is 20%. Okay, sigma L is 18%. The highest risk, which security is having highest risk in the question? Sigma L. And return of the L, you see, observe the return of the L, 20%. See, individually if you see, L is having maximum risk and return is only 20%. But if we inject M into the portfolio, if we add M to the portfolio, to our surprise, what happens? You observe the risk we can reduce to 0. That is happening. Return also maximizing, 21.9%, which is higher than the individual L's return. Observed? Can you see this? This is the magic of the diversification. Okay, this is the magic of the diversification. Diversification reduce risk. That's why these theories, okay, try to bring in try to find a certain way of investing. After those 50s and 60s era, the investing itself changed because of these theories. Because people started understanding these securities in a better manner. Are you understanding? With the data, how to invest, how to analyze, all this, okay, gathered momentum after that period. Right, copy this down. Yes. Shall I proceed?
Yes, sir.
Next, take question number 6 for discussion. European Limited has been specially formed to undertake two investment opportunities. The risk and return characteristics of the two projects are shown below. Expected return A and B. Risk of these projects 3% and 7%. European plans to invest 80% of its available funds in project A and 20% in B. The directors believe that the correlation coefficient between the returns of the project is plus 0.1. Okay, not plus 1, it's just plus 0.1. Okay, noted? Okay. Required. Calculate the returns from the proposed portfolio of projects A and B. What are these returns? Portfolio return, correct? First they have asked to compute portfolio return. Calculate the risk of portfolio. Comment on your calculations in part B in the context of risk reducing effects of diversification. Okay, part B la risk of the portfolio la we need comments. What they have asked? Yes, we need to pass on comments, right? Next, suppose the correlation coefficient between A and B was -1. How should European Limited invest its fund in order to obtain a zero risk portfolio? This is clear. Okay, same thing. Okay, take a minute time to go through the question, then we will start discussing. So tell me, this company European Limited is undertaking two investment opportunities, is analyzing two investment opportunities, that is project A and project B, correct? See, how would have they found risk? Tell me. 3% and 7% is the risk of the project given, na? How would have they found out?
Positive correlation.
Risk.
So that formula.
No, risk.
Portfolio risk, right?
Portfolio risk, individual securities risk. 3%, 7% is individual security risk. Portfolio risk they have asked us to compute. Okay, what is given in the question?
3% and 7%.
That is, what is that? 3% and 7% individual
risk of individual
project.
Individual security, sorry.
Yes, individual project. Now see how they would have found out these 3%, 7%, not using portfolio formula. Okay, this is risk of,
yes,
not risk of the security, this is risk of the project. Very simple. Okay, a company, I told you, a portfolio of securities is there, na? Portfolios companies is there, correct? That a portfolio may consist of various securities. A portfolio of projects means, okay, a company itself is portfolio. Yeah? In reality, what is happening? One business itself is portfolio. If you see Tata, if you see Tata group of companies, if you take a company, the company itself is engaged into various projects, na? They will have various projects in pipeline. Understood? Individually they will analyze the returns and risk from those projects. See, very simple. What is the expected return? 12% and 20%. How they would have computed? The 12% return of A, how would have they computed? Return of B, 20%.
Mean, sir, right?
Yes, that is not what I am trying to say is how they would have computed the return. You should tell me. Not like price at the year 1, price at the year beginning minus price plus dividend divided by price at the year beginning. This will not happen, na? Why? Because this is not a security.
Cash flow
Exactly. This is exactly as per the NPV, na? Capital budgeting. You have studied, na? Future cash flows they will analyze and find the IRR, na? Have you all studied how to find projects cash flow IRR? Intermediate capital budgeting syllabus la we found out IRR of the projects using the cash flows, na? Net present value. Okay, we use net present, we find net present value, we find IRR, correct? The rate at which discounted cash outflow becomes equal to discounted cash inflow. These we found out, na? Like that they have found out this is nothing but IRR. Because this is a project. Only one company, okay, there is only one company here. Portfolio means group of assets. Company itself is group of assets. Within a company also, there might be so many projects available in pipeline. Are you understanding? So it might invest in many projects. We learned divisible project, indivisible project, intermediate. Are you understanding? So
Yes,
which
sir.
means company itself is project. In the company, there will be many projects available in pipeline. So company itself want to maybe want to decide, okay, if it wants to decide how much of this how much of our available surplus is to be invested in each of the projects. Project A, they will analyze the IRR, they will project the cash flows from this project, and they will project the cash flows from other project, and they will compare it, which is more risky, which is less risky. So the project risk, how they will compute? See, expected return, I told you, is it is IRR. How they would have computed the risk? Okay, we have separate advanced capital budgeting in CA final. We have their Hiller's model and all. Okay, by which we will compute, okay, scenario based analysis, Monte Carlo simulation and all. We will find out how to analyze risk itself, project risk, how to analyze. We have this in CA final. Okay, are you understanding? So that is how they would have found risk, not using security formula, portfolio risk formula. They would not have found out. Are you understanding? So this question is not about securities, it is about project portfolio and project portfolio return and project portfolio risk. Okay, individually they have given, but cumulatively the formula will be applied. Okay, the formula might not be applied for finding individual risk of these securities and return of these securities, but when it comes to portfolio, same formula we will apply. Are you understanding? That is the only clarification. Shall we proceed? Okay, see here. You have understood, or you are having any doubt?
No doubt, sir.
No doubt. Okay,
Sir, I understood.
understood. All right. See here. Okay, it is heavily raining here. Right. Portfolio return. Projects, proportion, return and weighted return. A, B. What is the proportion? You should tell me, what is the proportion of these projects?
80% and 20%.
80% for project A. Correct?
Yes, sir.
80% for project A, na?
Yes, sir.
Okay. 20% for project B. 0.8 and 0.2. Next, what is the return? 12% and 20%. What is the weighted return? Okay, 9.6 plus 4, 13.6. This is risk-free return or risky return?
With risk, sir.
This is portfolio return with risk only. We have not reduced risk to 0 and all. Okay, we have not found out that proportion. Correct? Next, what have they asked? Portfolio risk. Correct? How to find portfolio risk? Formula portfolio risk will be same. How to find? Square root of W1 square sigma A square plus W2 square sigma B square plus 2 into W1 W2 sigma A sigma B into correlation of R of A and B. Correct? You apply the formula and we get it as 2.9%. Correct? This is portfolio risk. Part 1 of the question is complete. Calculate. Part 2 of the question is also computed. See, first part they asked us to calculate the returns from the proposed portfolio projects. Finished. Then they asked us to compute the risk of the portfolio. We have just computed as 2.9%. Is this clear? See, correlation alone is important. Point 1 they have taken. Clear? Because they have given in the question itself. Now in the third part, what they are asking, comment on your calculations in part B in the context of the effects of diversification. Correct? Risk reduction effects of diversification. See, what is the comment I will give you as notes. Okay, very simple. What is happening you need to observe. See, the 2.9% is the portfolio risk. What is the portfolio risk we found out? 2.9%. Correct? Hey, are you all there? Good
Yes,
morning.
sir.
Good morning, friends.
Yes, sir.
2.9%. Don't sleep. Okay, observe. Project there is A and B project. Two projects are available. Correct? If you see which project is having less risk, tell me.
A.
How much is that risk?
3%.
3%. See, carefully observe. Between these two projects, one is having 7% risk, another is having 3% risk. Individual risk itself is only is 3%, but the portfolio risk is only 2.9%. Are you understanding? This is the beauty of diversification. Because of the diversification, okay, our portfolio risk has even reduced below the minimum below the risk of the minimum the portfolio risk 2.9% is even below the 3% risk of the minimum risk security. Are you all understanding? See, minimum risk security in the minimum risk project, minimum risk project is how much? Project A. Which project is having minimum risk? Project A. Risk is 3%. But to our surprise, the portfolio risk itself is very lesser than the individual project risk. Yeah? Clear? And if you observe, the 3% risky project is having 12% return. Correct? Are you understanding?
Yes, sir.
But
Yes, sir.
our portfolio return, what is that? 13.6.
13.6.
That the beauty of the diversification is, okay, it is also reducing risk, it is also enhancing return. Clear?
Yes, sir.
Clear?
Understood, sir.
Both of you?
Yes, sir.
All of you? Yes. Next. Portfolio risk 2.9%. That is the comment I need to give you. I will dictate it as notes. Okay. Part 3 I'll dictate it as notes. Suppose the correlation coefficient between A and B was -1. Come to D part. D when the portfolio variance is -1, okay, what proportion we should invest in? We should form zero risk portfolio. When correlation is -1, we can bring the portfolios to 0. What is the optimum portfolio proportion? Proportion of the A is nothing but sigma B divided by sigma A plus B. Sigma is equal to 7 by, okay, 3 plus 7, 70%. Proportion of B is equal to sigma A by sigma A plus B, which is 3 by 3 plus 7 is equal to 30%. This is the optimum portfolio proportion. Can you all copy this down? A solution. See here, portfolio return. You copy this portfolio return. Shall we proceed?
Yes, sir.
Okay.
Yes, sir.
Next, see, we have finished question number 6 also. Okay. Question number standard deviation, coefficient of variation. Coefficient of variation is a separate discussion. We will discuss a few small topic only, but we will discuss, no issue, not now. We will come back to that later, but I want to discuss something called as correlation in detail now. Okay, shall we proceed? We will discuss now the concept of correlation. Yesterday, in all these questions, correlation is given, correct? The number correlation, if you notice, they have given, correct? But question the correlation computation itself is a task. Yeah, okay. We need to compute correlation itself. We need to know what is this correlation, how to find this correlation. We need to know, na? Correct? We will discuss it now. See here. See, for finding correlation, there are two methods in the two situations. You can have two situations wherein in the first situation, without probability, exposed data we took, correct? In that situation, we can compute the correlation, and with probability, ex ante data, also you can use and find the correlation. See, in the question 1 we will take for a discussion so that you will understand it further. Where is the question 1? See here, question number 1. Here, if you carefully observe, we need to find correlation, correct? We will find it out. There is a formula and we will find it out. That is not an issue. But carefully observe, the first year, what is the return the security X is giving? 6.6%. What is the return the security Y is giving? 24.5%. Correct? The second year when it comes, the return of the X is dropping. correct? I am observing security Y's return is also dropped. Understood? Then the second year, then the third year, from second to third year, it has further reduced, but this has increased. The fourth year, third to fourth year, this has increased tremendously, okay, and this has dropped, correct? Now in the fifth year, 12.6, it increased, it also increased. Now I see that there is some sort of correlation, okay, but I don't know what is the strength of the co-moment. Okay, this is not perfectly correlated, but I see sometimes there is some relationship. There is commonality is there. Whenever it is coming down, it is coming down, and whenever it is coming up, it is coming up. Two situations it is not matching, yes, but what we need to find out now, there is some sort of relationship I can establish, but how much the strength of the co-moment, we find it out using correlation, correct? See. Okay, see here, correlation of x and y. There is a formula for correlation of x and y, that is covariance of x and y divided by, okay, sigma x into sigma y. This is, okay, without probability or with probability, you will find out. Okay, correlation is simply covariance of x and y divided by sigma x into sigma y. This is the formula. Now you may ask, what is covariance? Covariance is nothing but, okay, summation of x minus x bar into y minus y bar, okay, the whole divided by n. This is the formula for covariance, okay. Now covariance of x and y, this is when probability is not given, okay. When you are analyzing exposed data, your covariance is what? Summation of x minus x bar. Okay, I told you in the comma is understood as bar, x mean, okay, x minus x bar, we got it na. The third column, we found out x minus x bar, remember, correct?
Yes sir, yes.
And in fourth column, y minus y bar we found out na. Adavadu y minus y bar na, in the next slide, when we see, very simple pa. Security x you had, x bar we found out mean, correct? X minus x bar we found out of the security x. Then security y we have y minus y bar, correct? Now we are finding correlation na, co-moment of these na. So there should be some relation between those two securities we need to establish. Upon what we will do, for individual security x minus x bar we are finding na, you multiply it with y minus y bar. Understanding? We will include one more column and we will find out that. And you will add summation of the y minus y bar, the column, okay. Then you will divide it by n number of observations, and then you will find the covariance. This is using what is this? This is using probability or without using probability? Without using probability. With probability, this is the formula for covariance. Summation of probability into x minus x bar into y minus y bar. There is no n involved, okay. Now this is covariance, not correlation. How to find correlation? This covariance you will take and divided by sigma x into sigma y. Shall we proceed? I will show you. Very simple. But take question number 1. Correlation we will find from given question number 1. Question number 1, are you all having in your hand? Workbook you are having in your hand. See question number 1. You have to help me with the data. Okay, year 1, 2, 3, 4, 5. 5 years data is given na? Correct? This we are finding using exposed data, not with probability, okay. This we are finding with probability or without probability? Without probability, okay. Very simple, with probability and the n will be gone, probability will be included, weight probability will be included, which means weight should be given as per probability, okay. Simple average, you just divided it by n. Are you understanding? See, 5 years data is given, security x, security y, all these are given, already given, and it's something new, we already know this, correct? What is the mean of x? Take your solution answer sheet where you found out mean. What is the mean x bar for the first question? Tell me.
5.96.
Correct. And the same question, x minus x bar 0.64 minus 0.36 minus 14.96 6.64, all these were same, correct?
Yes, sir.
Y minus y bar, just fill it out. What is y minus y bar? 15.4 minus 15, 10 point, minus 16.9, 5. Till now, anything new we are discussing? Nothing new. Already
No.
we know, correct? We collect data from both these securities because we are finding the co-moment. So we will mix it up. Are you understanding? Now, last column, what we will do? Individual security, we found out x minus x bar as 0.64, y minus y bar as 15.4. Now what you should do? You should multiply this x minus x bar into y minus y bar. Are you understanding? Up 0.64 into 15.4 for each and every security. Take out your calculator, calculate it. 0.64 into 15.5, 15.4. How much is that? 9.856. Are you all getting?
9.856, sir.
Minus 0.36 into minus 15. See here, sign is very important.
5.4.
Here sign is very important. There sign is not important because we squared it and found out the total. Adanal that will be irrelevant. Here the sign is important. Why? Because we are finding co-moment. So negative correlation, positive correlation, this sign will affect the correlation. Are you understanding? So inge sign negative positive is very important. Clear? Up minus 0.36 into minus 15 is how much? Minus minus gets cancelled. How much is that? 5.4. Minus 14.96 into 10.8. How much is that?
161.
Minus 161.568. Next minus 112.216 and plus 445.828. Are you all getting this last column? How to compute? Clear? That correlation when they ask to compute, this is we are computing first correlation. Other first step is computing covariance. Are you understanding? First step of computing correlation is computing covariance. Why? Because correlation formula R into xy is equal to covariation of x and y divided by sigma x into sigma y. Clear? Now see here. Now what is the summation? What is the total for this? Last column total in plus minus is important. Don't just total, minus plus you do and find out the total. Minus evlo? Minus 212.7. Are you all getting this? Next, see here. Now covariance formula in what is the formula? Summation of x minus x bar into y minus y bar. What is the summation sigma? In the sigma is in the sigma. What do you mean by this summation sigma? Sigma is sum total. Okay, total we just found out 212 point. How much is that? Numerator 212.17 divided by n 5 divided by 5 is how much? Minus 42.54. This is covariance or correlation? Covariance. Now we need to find out correlation. Correct? How to find out? Very simple. Take out your notebook and find what is the sigma x and sigma y. You put it in denominator. Okay, minus 50 covariance divided by sigma x into sigma y. Sigma x, sigma y you need to compute. You already have the data. We have the data. Upper directly you can substitute. Minus 42.54 divided by 8.16 into 13.39. Correct? 8.16 we got sigma x. First question you see that your notebook you can get it at 8.16 and 13.39 is sigma y. Okay, then covariance of x and y is minus 42.54 divided by 8.16 into 13. How much you are getting? Sign is important. Minus or plus? Minus is how much? 0.39. Round it off to 2 decimals. 0.39 you will get. Are you all understanding this? How to compute correlation? Comfortable?
Yes.
Okay.
Yes.
Nothing you understood, just by the formula. But logically explained how to compute. Okay. This is how you will compute. Only thing is, what is covariation? We will discuss it in next segment. Don't worry. Okay. See here. Till now you understood. Okay. Copy this down. See. You copy. Just listen. Okay. The question number 2. You cannot find correlation with the probability. You might think. Okay. See, in the question number 2 cannot be used for finding correlation using the probability method. Correct? Because the question number 2, the probability is given for x and y is totally different. Different scenario for x and different scenario y they have analyzed. These scenario are not same for both x and y. Are you understanding? When you do probability based scenario analysis, If you assign a same probability, same scenario for both these securities, then only you can use the data to find out the correlation. Which means the question number 2, they have given X and Y data. There is two different set of data. It is based on ex ante data, but it is two different set of data. For example, if you observe, probability of X 0.05 is given, correct? First probability. Y is also 0.05, but the second, if you see, 0.20 is given for X. Second question I am telling you. If you have workbook, you can just notice. Okay, I don't want to separately discuss that. So, okay.
So if the probability are same, then this formula can be
Yes,
can be.
if they given the probability in the left hand side is same, okay,
Yes,
then they have given the return and risk of the return for the individual securities in the second and third column. Are you understanding what is happening? Which means the
Yes,
first
I
leftmost corner they have given probability which is same for both the security, and using that same probability they have given you return vechukko. If that is the situation, you can think like this, okay? Which means for a given scenario, how X behaves and how Y behaves, they have given. That is one situation. If that is the situation, you can use the this formula for finding co-movement. Are you understanding? If they give separate probability based scenario for X, separate probability for based scenario for Y, then you can find it out weighted return, and for risk computation you can take probability individually, but co-movement you can never find, okay, because the scenario itself is different. Ideally you will need to
yes, sir.
Find a common scenario. They have not given that, which means they are not analyzing collectively, they are individually put the data. But that will not show anything for us. It will not give any meaningful number for us. So there is no use of computing correlation. Correlation nale co-movement dana. Okay. One more example I wanted to give you for correlation, very simple. Suppose a person is there and its shadow is there. Perfectly correlated. Understood? Whenever a man moves, shadow also moves. Okay. Don't think about direction and all. Yeah, how sun is there, don't think. But whenever a shadow is there, direct to moon shadow is there, don't think like that. Generally, I'm telling. When a person moves, shadow is also follows, 100%. Okay, it is perfectly correlated. But you see correlation, but not perfect correlation. One more example I can give you, like pet. Many people will have pets, dogs, cattle. Okay, have you all seen? They will take the pet and take for walking. Sometimes they will leave it as it is, and they usually it comes behind. Wherever the person goes, pet also comes. But sometimes when there is food, it will stop there and start eating that and then come back. Are you understanding? This is not perfectly correlated, but correlated. Shall I proceed? Copied?
Yes, sir. Yes, sir.
Okay. So question number 2, you cannot consider that for calculating. I wanted to give you as homework to compute correlation using probability. But the issue is, if you notice, this is I told you, 5% is there, 5% is there. This scenario is same, correct? Assume. But you get 20% chance and 25%. So scenario itself is changes. Third scenario 50%, 40%, 20%, 25%. The entire scenario changes in the three situations changes. So you cannot use this data for computing correlation amongst X and Y using this probability based formula, right? That is not possible. Next, the correlation level. So what we understood, see here, correlation without probability. Please help me with covariance. What you should do? Covariance sort of formula will differ. What is the covariance formula? See here, covariance of X and Y divided by sigma X into sigma Y. This is correlation, correct? But covariance is equal to covariance X and Y is equal to when there is no probability. What is the formula? Just a revision. What is the formula?
Sigma X minus mean.
Sigma, this sigma is summation, okay? X minus X bar into Y minus Y bar, the whole divided by n. Understood? Now without with probability, come back here, with probability, okay, you will do covariance x and y divided by sigma x into sigma y. This will remain same, but because the covariance will change. How the covariance will change? See, covariance x and y is equal to sigma, okay, into sigma prop p, okay, sigma p into x minus x bar, y minus y bar, okay. This is the formula. Are you understanding? And the last column x minus x bar into y minus y bar is there, na? What you will do? You will add a probability into it. P into x minus x bar, y minus y bar, like that you will add, and total data will be there. Last you should add. Don't divide it by n. Commonly committed mistakes by the law. Okay, you can give a note that you should remember. When you see the probability, now you should never divide it by n. No use. Okay. Next. Now see, because of this correlation, difference in correlation, our portfolio risk. What is this? Portfolio risk formula. We need to revisit. What is our portfolio risk? Without probability, with probability. With probability, like that, or without the data given for covariance, okay, with the data of covariance, like this you can segregate. Upper two formulas, okay, you will get without for probability, with probability, don't need to write, okay. Two formulas are there for portfolio risk. What are those? See, simply first formula we just computed, na? What is that? Please tell me. W1 square sigma x square plus W2 square sigma y square plus 2 into sigma x W1 into W2 sigma y. Any order you can write, you just need to remember, okay, into R into correlation of x and y. Correct? This is one way of representing. This is one formula. Second formula also you can come across in the module, study module, okay, examination, past examination question, answers, suggest answers, all these will be there. You won't get confused. See here. Second is very simple, using covariance data. Okay, what is that? Weight W1 square sigma x square, this is same, plus W2 square sigma y square, correct, plus, okay, 2 into W1 sigma x W2 sigma y, okay, into covariance of x and y divided by sigma x sigma y. This is what is correlation, na? Correct? The correlation I substitute by using this formula. Nothing, yeah, nothing great. Old,
substituting.
Old wine in new bottle. Okay, substituting the formula in the existing formula. Now what I will do? Sigma x will get cancelled here. Sigma y will get cancelled here. Are you understanding? So this we can simplify and write. See here, W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 into covariance of x and y. Bus. Are you all understanding? Like this I can simplify also and write it. Is this clear? Visible? First clear? This is one type of formula. This is one way of representing. Okay. This is another way of representing. Both way you can come across in the module and all. Okay. Is this clear? Either kudutana, you should not fear. See, either kudutana, you carefully observe. Here denominator sigma x and sigma y will vanish. There also weight near the weightages that will vanish. What is the formula? W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 directly covariance of x and y. There is no sigma x or y in both numerator as well as denominator get cancelled. Puriyarda? This is clear. This is also one of the way where it will be used, you may ask, correct? Sir, where can I use this formula? Very simple, pa. Instead of correlation, the question gives you correlation, na? Usually in these questions they have given r is equal to 0.1, r is equal to 0.5, like that they have given, na? Minus plus, like that they have given, na? Like that they will give you in the question covariance also. Appa you should carefully observe, they have given correlation, they have given correlation, covariance. Covariance is a different number from the correlation. Are you all understanding what I am trying to say?
Yes, sir.
Okay. Covariance, when they give correlation, you should use this formula. When they give directly covariance, you use this formula and find it out. Are you understanding? Okay. Next, so two formulas are there for portfolio. This is possible. Do you need to copy? The notes is available, na? In the printout is available. This is sufficient, or you want it to note it down? After also you can note it down in your notebook. Is it fine?
Yes, sir.
Sometimes PDF curriculum, in this PDF it gets misplaced. Okay, what do you do? I don't know whether you do it or not. All the PDF classroom notes is there, na, which I am writing in this OneNote. Okay, this you have as PDF in the separate folder. Don't worry. Okay. Next discussion is, see, one more discussion I wanted to make here. What is the, okay, this is separate discussion. Now we are going to another discussion. We know how to construct a portfolio risk of the portfolio which is having two securities. Portfolio risk consists of two securities. How to find two security portfolio risk? This is how we found out. Sigma, okay, A plus B the whole square. Two risk portfolios like this we found out. Correct? What is the formula? W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y r x and y. Correct? Now when you want to cut, ideally, see, for example purpose we are taking for simplicity purpose to security portfolio, but in real scenario the portfolio will consist of many assets, only two assets, many assets. Okay, it might be 10 security portfolio, it might be 15 security portfolio. Are you understanding? So how to find, okay, more number of securities portfolio risk? Okay, the portfolio risk which is having more number of securities, how to find the portfolio risk? In that case, portfolio risk, I will show you 3 securities portfolio, then we will arrive at some conclusion to find out n number of securities, okay, inside the portfolio. Risk of n number of securities in the portfolio. See here, portfolio risk having 3 security. 3 security portfolio risk, how should we compute? See, correlation, you should remember one more thing, correlation will only be happening between two things. You cannot judge a co-movement of 3 things. Okay, one husband can marry only one wife, one person can marry only one girl, like that. Okay, polygamy is allowed. Okay, like that. Correlation, what you should understand, you can only use correlation between 2 securities, not multiple securities. Up 3 securities, what we will do, we have x, y and z. Okay, portfolio having security x, y, z. Correct? What do you do? Individually, first weight, okay, weight 1 square, W1 square, sigma x square, okay, plus W2 square, sigma y square, plus W3 square, because the weight of the individual security is important, na? Okay, weight square, weight of z will be there, na? Okay, z, risk of z square, plus 2 into W1, W2 you take. What are you taking? Weight 1 and 2 of which securities? Sigma x and sigma y into, okay, correlation of sigma, correlation of x and y. Clear? plus, okay, 2 into W2 W3. What do you do? Sigma y, 2 na second security is y na, okay, then weight of third security na sigma z, understood, into correlation of which two securities now, 2 and 3 na, yz, correct, plus 2 into W1 W3. Are you understanding what is happening?
Yes, sir.
Sigma x into sigma z, because x and z is W1 W3 na, weight of x, weight of z. See pa, what is W1? See, we have three securities. See, wait, we have three securities in our portfolio, correct? Say this is 20%, this is 30%, this is 50%. Are you all understanding? Upper weight 1 is weight of x, weight 2 is weight of y, weight 3 is nothing but weight of z. Are you all understanding this? Upper what do you do? 2 into W1 W3 sigma x into sigma z into correlation between what? Weight 1 and weight z, na? X and z. X and z. Are you all understanding? This is in the square root, the whole square root is there. Okay, see here. This is the formula for 3 security for portfolio. With this, can we arrive at a matrix? See here. I will show you in the matrix. Very simple. We have 3 securities. Na? We have 3 securities in our portfolio. Na? Correct? What we will do? We will draw a matrix wherein, see here, you get W1 sigma x, W2 sigma y, correct? W3 is always represented as sigma z, represented with sigma y, correct? Now see here, okay, here W1 sigma x, W2 sigma y, W3 sigma z. Are you understanding this matrix? See, I will explain you. Here in the matrix, you have how many boxes? 9 boxes. Can you see this? Forget about this one and this one. Okay, this one arrow marker clear. This and this you forget. This is for reference. The matrix contains 9 boxes, na? Okay. See, very simple. In the matrix, multiply this with this. Multiply this number with this number. W1 square sigma x square, correct? Are you understanding?
Yes, sir.
Here also W2 sigma y, here also W2 sigma y. What you will do? W2 square sigma y square. Okay. Here also W3 sigma z, here also W3 sigma z. What do you do? W3 square sigma z square. This you are getting, correct? Very simple. 3 boxes are filled, na? Square boxes. That is nothing but first one, second one, third one, correct? Are you understanding? Now what we will do? W2 sigma y into W1 sigma x. What is that? W1 W2 sigma x sigma y. Understanding? Same way. W1 W2 here, na? This and this, this and this. If you multiply, what is this box? You should tell me. W1 W2 sigma x into sigma y. Getting? Now third, what is this? W1 W3. Can you see this one and this one? Okay, what you will get? W1 W3 sigma x into sigma z. Now this column you fill it up. What it should be? W2 W3 sigma y sigma z. Okay, fill this box. W3, okay, W1 sigma x sigma z, correct? Fill this box. W2 W3 sigma y sigma z. Are you all getting this? Correct? Now very simple. in the W1, see here, I will put it on separate either. Okay, can you see this? I will change the marker now. See this. W1, W2, sigma x's y is there. Clear? Can you see this?
Yes, sir.
Same number, where it is? Here also. Can you all see?
Yes, sir.
Correct? So, what we will do?
Yes, sir.
We will add this. What is this? If we add this, 2, see. If we add that number, what we will get? 2 into W1, W2, sigma x, sigma y. Very simple. Correct? Very simple. Right? 2 numbers are there, na? 2 plus
Yes,
2.
sir.
2 plus 2. You what you will do? 2 you take it as common. Understood? This is clear. Now come to other thing. Same way. Here there is W3, W1. Can you see? W1, W3 into sigma x into sigma z. Understood? Same way. Where we have the same thing here. Can you see? Matrix then. W1, W3, sigma z into sigma z. Sigma x into sigma z. Correct? Up we have one more data. Plus 2 into W1, W3, sigma x into sigma z. Okay? Understood? Clear? Shall I proceed?
Yes, sir.
Now, see here, third. Come to third one. What is that? W2. Okay, can you see this rows number, rows marking? W2, W3 into sigma y into z. Here also W2, W3, sigma y into z. Correct? How can you write 2 into W2, W3, sigma y, sigma z? Are you all getting the point? My point?
Yes, sir.
Now I am putting this number separately. Okay, the red this is called as variance term. The square is there, na? See this. Okay, the square W1 square sigma x square, W2 square sigma y square, W3 square sigma z square. These 3 terms collectively I called it as variance term. Variance term. Are you understanding? Okay. And other 6 terms are there, na? The green ones. Are you all seeing? See here. The green one. Okay. And the pink one. And the yellow one. All these 3 I tell it as covariance term. Covariance term. Are you understanding? How many in the matrix, how many boxes are there? First to tell me. 9 boxes are there. Correct?
9.
First, we are computing portfolio risk of consisting of how many securities? 3 securities. In a 3 security portfolio, there will be 9 terms. Are you understanding this first? There will be n square term. 9 term. 3 into 3 square it up. 2 security portfolio, how much total box will be there? If you draw a matrix, how many boxes will come? 4 boxes will come. Understood? 2 square. Like that, 3 security portfolio, how many boxes will come? 9 boxes will come. And the 9 leon, what is the distribution? 3 variance term. Are you all seeing this? See, this one, this one. These 3, can I put it like this? Okay, these 3 is called as variance term. Other 6 is there, na? These are called as covariance term. Okay. In the formula, if you carefully observe, these 3 are covariance term. Understanding? And here each one has 2 covariance term. This is variance term. These you are having now 2 into W1, W2, sigma x, sigma y. This is covariance term. 2 here plus 2 plus 2. Total how much? Total how much?
6, sir.
6. Clear? So we can conclude like this. Very simple. I will tell you a secret. Nothing. We see 2 security portfolio. Okay. how many terms will be there first? 2 square terms, 4 boxes, correct? Adula you can divide this 4 into 2. Various term, covariance term. Okay, variance term will be 2, covariance term will be 2. We saw that, correct? 2 security portfolio, there were variance terms. See here, shall I need to show you this? See here, can you see this? Okay, inge if you carefully observe, this is variance term or covariance term, you need to tell me. Variance term. Square. This is variance term. This is 2 security portfolio. Now, how many variance term you have? 2 variance term. Correct? Covariance term you come. This is covariance term. Na? How many covariance term? 2. Because 2, you multiplying is 2. Na? There are 2 things. Actually, if you draw matrix, na, you will get 2 variance term. Baki 2 le, other 2 you will get as covariance term. Are you understanding? Clear? So, in the 2 security portfolio, total terms will be 4 and it will be divided into 2 and 3. Come to 3 security portfolio. 3 security portfolio, okay, you will have 3 square terms. How much is that? 9. In the 9, if you distribute, how much is the variance terms? You should tell me. Variant term evlo, covariant terms evlo. Variance term 3. Correct? See here. 1, 2, 3. Correct? 3 variance terms.
Yes, sir.
How many covariance terms? 6 covariance terms. So, tell me children, can I conclude it like that? Whenever you want to n security portfolio, n security, whenever you are creating n security portfolio, okay, total terms will be n square. See, total terms is equal to n square. Are you understanding? And see, variance term will be I can distribute it like this. Variance term, covariance term. Variance term will be n. Understood? Okay. 2 security portfolio, how many variance? 2 variance term. 3 security portfolio, 3 variance term. What is this? Covariance, how much it will be there? N into n minus 1 term. Understood? Or n square minus n. This is same, na? N square minus n, if you take n as LCM, you will get n minus n1, n into n minus 1. Same. Are you understanding? 3 upper, you should tell me. Portfolio consists of 100 security. Portfolio consists of 100 security. What will be, how many terms will be there? Total terms in our formula, how much should be there? Total terms evlo? First you have to tell me 100 security. Na? How much will be term? You should tell me, I will not tell you. Total terms.
10,000, sir.
Exactly. 10,000 boxes will be there. Matrix potter 10,000 boxes will be there. Out of this 10,000, you should tell me how many variance terms will be there and how many covariance terms will be there.
Variance.
Exactly. Apo covariance is, tell me.
9,900.
Clear? Are you understanding why I wanted to discuss all this? Na? First is that you need to compute how to find, you need to see how to find a portfolio consists of 3 security. They will ask, okay, 3 security portfolio, there is a question under sharp single index model. At that time, they have asked a question wherein they asked us to compute this method and sharp method. Both they have combined in a question and given. Okay, there is an institute question. So you need to know how to compute it. That is first reason. Second reason is you need to know that when we inject more and more security into our portfolio, carefully observe, when we include or inject more and more, okay, securities to our portfolio, ultimately portfolio risk when you are computing, the co-moment becomes the covariance, and ultimately covariance is nothing but a working note of correlation, correct? The correlation becomes more severe and important. Are you understanding? The co-moment determines what is the path, okay, what is the, how much the risk reduction will happen. This is co-moment will determine. Understood? This is variance na, individual security risk. What is variance na? Okay, what is variance? If you root the variance na, individual risk you will get na. Are you understanding? See, variance na, weight 1 sigma w1 square sigma x square, this is a variance term na, correct? Standard deviation I told you is nothing but root of variance upon w1 sigma x, weighted average risk of the individual security na. Apo whenever I am moving ahead and including more and more securities in my portfolio, okay, individual risk of the security will become irrelevant. After some point, individual risk of the security will become irrelevant because the group's co-movement is there na. The securities co-movement is there, that will become more relevant and more powerful. This is why index funds and all there, I told you na, index fund is there, Nifty 50. If you are investing in top 50 companies, okay, when you are investing in index funds, it is less risky, it is to be regarded as less riskier than this ordinary portfolio, okay, which doesn't consist of all the composites. Why? Because, you know, when you add more and more security to the portfolio, individual risk itself becomes irrelevant. Yeah, are you understanding? Co-movement becomes more relevant, and that is why index funds are more prominent. Okay, know nothing investor, which means a person knows nothing about the stock na, simply buy the index of the country. If you are in India, you can buy Sensex oriented fund, index funds, okay, Nifty 50, Nifty growth funds, Nifty mid cap 100 funds, okay. These are all kind of different indexes forms na. Based on indices, the index funds will be there. Okay, when you invest in index funds, why it is more irrelevant na? Why the risk of the individual security is more irrelevant na? Their co-movement is there na. See, suppose if the collectively economy is doing good, if collectively Indian economy is doing good, entire index will go up, your portfolio value will go up. That's why co-movement is very important. Are you understand? These are all undum puriyana, forget about it. Okay, don't worry, I am just throwing some light into practical perspective. If you understood, well and good. If not, if you remember, formula alone is sufficient. But these are all deep conceptual discussion, so I hope you will understand. Puriyarda, enna solrena? Clear? This is clear? Friends, shall I proceed?
Yes, sir.
If you have any doubt till now, please ask me. Okay, shall I proceed? I assume you don't have any doubts. I will share the notes now itself. This matrix is clear now, okay?
Yes, sir.
How 6, 2 times the yellow is coming, 2 times into yellow, 2 times green is coming, 2 times the pink is coming. So altogether you got 6 times, correct? Right. So this is how you find portfolio for N securities. Okay, I have given us notes, I will just show. I don't have time to start Markowitz portfolio theory, which we will start discussing in our next class. Okay, that is tomorrow morning. See here, I have given this as notes also. You can go through. See, calculation of correlation is given as 0.15. Okay, question number 1, without probability calculation of correlation, covariance is calculated using this. Ultimately, it will have effect in correlation also, because you calculate in different methods. Alternative formula for calculating portfolio standard deviation is W1 square sigma W square sigma 2 into W1 the covariation. This I already discussed, correct? And risk of a 3 security portfolio is this. I do the matrix. Okay, I hope you will go home and revise. Then we can observe that there are 9 terms in security. Okay, n terms, n minus 1 will be the covariance term, n into n minus 1 will be covariant terms. 100 square, 10,000 terms, 100 into 99, 9,900. Okay, right. You can, I left it space, if you want, you can mark it down. Okay, right. Markowitz portfolio theory. So with this we have completed. See here, if you carefully observe in the next, in the previous class I told about 5 different segments we are going to discuss in the entire chapter. We have exhaustively fully completed the first segment, that is risk return profile. With this, what we have completed? Risk return profile. Clear that? Okay, the chapter is so profound that you have to keep on revising to understand more and more about upcoming theories. Why? Because see, basic and first Markowitz theory came. Then thereafter they developed CAPM. Okay, made some addition. Then CAPM they reformed, okay, and Sharpe single index based model came, and Sharpe came up with a single index model, okay. Then CAPM is there na, okay, purification of the CAPM. He tries to do arbitrage pricing theory, wherein they added factors also and then enhance the macroeconomic factors. All this. So why I'm telling you is this na, the entire the flow of discussion will be so interlinked and so interconnected that you cannot leave one topic alone and then tell I can directly study in index models, okay, Sharpe single index model, because the base I am laying the foundation for you to understand the upcoming topics. Are we clear with this? So revise properly, that is my request. Will you do it? Okay, within tomorrow you should revise this topic properly. Okay, go through the notes, go through I will send you this PDF also. Now itself I will upload this PDF as well as the already you have the workbook classroom notes PDF na, that also you can go through, right. Lectures also I will upload in the app now itself, right. So we will close now. Thank you. Today's session we are closing. Tomorrow morning sharp at 6 AM we will start. Thank you.